Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 115 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be particularly useful to you in your long-term financial journey. Today, we are going to round out the week on books you should read in 2021. And I have already talked about 4 books this week, and I'll just real quick recap those. I've already talked about The Total Money Makeover by Dave Ramsey and the plan that he lays out for your personal finances. Obviously, that is more of a personal finance book when it comes to budgeting, getting out of debt, and all of those things that I preach on pretty consistently. And then we talked about The Intelligent Investor written by Ben Graham and how that is such a foundational work on the idea of value investing and just investing in general. Then we talked about The Little Book of Common Sense Investing by John Bogle and the impact that that book has and how we should be keeping costs low when we invest and taking into account taxes and things of the like. And then yesterday we talked about stocks for the long run and how when we invest, we should be investing for the long run and not just over a short-term time horizon and the benefits of investing over the long term. And then today what we're going to be talking about is Howard Marks' book, The Most Important Thing. And I think this book can go a long way towards just informing you on how to think about investing and the things you need to keep in mind when you are making investment decisions. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below as we go through this episode, and I'll be sure to get back to you. Any questions you may have, just leave them down there. If you're listening on Apple or Spotify podcast, then be sure to subscribe there and leave me a review, hopefully a good review. And then follow me on social media at MNO with Dylan, and that's good supplementary materials to the things that I'm putting out day by day in these long form episodes on either the YouTube channel or the podcast. And then if you need somebody to help you walk through your financial life, somebody to help you create a plan that is specific to you and your family and then keep you accountable to that plan, I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and then you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now, many of you heard me say the name, but who is Howard Marks? Who is this guy that wrote this book? He is not as big a name as many of the individuals who have written the books that I've talked about earlier this week, but he is still a very big name in the investing world. So who is this guy? Well, Howard Marks is an American investor and writer. Obviously, he wrote this book and a few others. Mastering the Market Cycle is another one that he wrote that I think is very, very good. And he is the co-founder and co-chairman of Oak Tree Capital Management, and he is the largest investor. His particular company is the largest investor in distressed securities worldwide. And when we talk about distressed securities, we're talking about things like distressed debt, which is companies that may be about to file bankruptcy or having some type of financial hardship, their debt. So they are the largest investor in that. And so you would think, well, is this a guy that invests in a bunch of risky things? Well, maybe not as much as you think, especially if you read The Most Important Thing. And that's what we're here to talk about today, The Most Important Thing. This book that you would think, okay, the most important thing, he's going to talk about one thing that is the most important thing in investing. And that is just not the case. The most important thing is written as, hey, there are many things that should inform your investing decisions. There are many things that can help you to make an investment decision. And there are many things that are the most important thing at any point in time within that decision-making process. And so he talks about all of these different most important things. Because he says that successful investing does require thoughtful attention to many separate aspects all at the same time. And that is important for us all to understand, is that you can't just focus on one aspect of investing at any given point. You have to be thinking of your investing holistically, especially if you're investing in specific securities. You have to take several things into account before making a decision. You can't just make a decision based on one thing or one piece of information, because obviously that can really push you toward a short-term mindset. And that is not what we want as investors. Now, I love what Marks does in this book. And so what I want to do with you is go through all of these most important things and talk about what they mean, what he's talking about here, and how it can inform your investing moving forward. Now, the first most important thing that Marks talks about is second level thinking. And second level thinking is something that is not commonly talked about in society. We don't really use that phrase, second level thinking. But here is what he means. He uses the example of first level thinking being, hey, this is a good company, let's buy the stock. Okay, so that is first level thinking. It's good, let's buy it. It's good, let's buy it. It's bad, let's sell it, right? That's first level thinking. But what if you took this second level of thinking? And that second level of thinking is saying, okay, it's a good company, but maybe everybody thinks it's a great company, and it's just not. So maybe the stock is overrated and overpriced, so maybe we should sell it and not buy more of it. And so this idea of second level thinking, he says, is one of the most important things in investing. He says that first level thinking says the outlook calls for low growth and rising inflation, so let's dump our stocks. But second level thinking says the outlook stinks, but everyone else is selling in a panic, so let's buy. So basically he's saying in second level thinking, maybe you need to take a more contrarian view. And he talks more about contrarianism within his book, The Most Important Thing. But this is taking the opposite view of most, because maybe that is where you can be the most profitable. And this is just another step in your thought process and your decision-making process that you can take to where things may seem very cut and dry. So for instance, I'll use an example. Your Amazons, your Apples, Googles, I mean, these are companies that have been around for a while. They will be around in the immediate future, barring some, extreme thing happening. And people who think that is the case just go, well, they're good companies. They're good companies. I am going to buy these good companies. I'm going to buy these up, and that is what I'm going to invest in, which has proven to be a pretty good strategy thus far. But at what point are they overbought? At what point are they, overrated? And that is what Marx is, really feeding into here, is saying maybe we shouldn't just think, this is a good thing to invest in, let's invest in it. Maybe we should think, well, this is a good thing to invest in, but what else? What other thing could be impacting our ability to make money in this area? He also says that first level thinkers are very simplistic. They just have an opinion about the future. Whereas a second level thinker takes several things into account, such as, what's the range of likely future outcomes? What outcome do they think will occur? What's the probability that they're right? What does the consensus think? Does my expectation differ from the consensus? How does the current price for the asset comport with the consensus view of the future and with my view of the future? And is the consensus psychology that's incorporated in the price too bullish or bearish? Meaning, what's the market sentiment like? We take all of these things into account as second level thinkers. So as an investor, it is important to be a second level thinker. He then goes on to talk about market efficiency and what market efficiency is. And, market efficiency is simply that, there are many participants in the market. They share roughly equal access to relevant information. They're intelligent, objective, highly motivated, and hardworking. Their analytical models are widely known and employed. And so for a market to be efficient, it's all about information. How much information is available, and is that information showing up in prices? And in efficient markets, the prices do reflect the information that the public has. And in the strongest form of efficiency, it includes all information that is in the market. And so his big point about market efficiency is that even though markets are efficient, there are mispricings, right? There are times when the market can misprice assets, and that's what he has made a career on. He has made a career on mispriced assets, and when distressed debt is selling for much cheaper than it should because people are very bearish about this distressed debt, then he will buy it up. If stocks are being pushed down because of a bearish psychology in the market, then he may be buying them up, or the opposite may be true. If everybody is very bullish, he could be in sell mode. So he's saying that even though markets are efficient, there can be these instances where things are misvalued, and we need to try to take advantage of that misvaluing of assets that goes along with the idea of market efficiency. He then goes on to talk about the most important thing being value. And we've talked already this week about the intelligent investor, and that is the ultimate value investing guide that is written by the father of value investing, Ben Graham. And so if you want to know anything about value, that is where you learn about value. But he talks about the most important thing being value. And so he's saying that for investing to be reliably successful, an accurate estimate of intrinsic value is the indispensable starting point. And so we talked about this earlier this week when we were talking about Mr. Market, and we were talking about when the market is giving you different prices from time to time, and that kind of goes along with efficient markets, that even though markets are efficient, the market can offer you prices that either make sense or don't make sense, like Graham says they do in The Intelligent Investor. He says Mr. Market can offer you prices that do or do not make sense. But along with that is the idea of value investing and the margin of safety. So having a significant enough margin between what something is worth and what you are buying it for that you can make a relatively good gain. And so that is nothing more than what is being said here by Marx when he is saying that what we have to start with is an intrinsic value. We have to start with knowing what something is worth. And if you know what something is worth, then you can look at what it is selling for in the market and make a good determination as to what you should do. Because if you don't know what something is worth, then there is no way to make a good determination of buying or selling or any other type of investment decision. And he goes on in talking about value to talk about value investing versus growth investing, and growth investing, representing a bet on a company's performance that may or may not materialize in the future, while value investing is based primarily on the company's current value and the analysis of the company's financials. And he makes a statement that being too far ahead of your time is indistinguishable from being wrong. And I love that statement because basically what he's saying is if you find something out and you're way ahead of the game, and prices don't end up revealing what you want them to reveal within a certain period of time, then what's the difference between that and being incorrect? And the answer is nothing. He said if you liked it at 60, you should like it more at 50 and more at 40 and more at 30. You should like the stock regardless of the price. You should like the investment regardless of the price. But your decision to buy or your decision to put money into something should be based on what you think the value will be in the future. And then he talks about why the most important thing is the relationship between price and value. And that investment success does not come from buying good things, but rather buying things well. And this is what I was talking about earlier when I was saying, if you're going to buy Apple, well, Apple may be, really high in valuation. So maybe you are buying a good thing if you were to buy Apple stock, but are you buying something well? That's a determination you would have to make for yourself. And he said that no asset is so good that it can't become a bad investment if bought at too high a price. And there are few assets so bad that they can't be a good investment when bought cheap enough. And so value has a lot to do with whatever the current prevailing market price is. And so he's saying that in order to make a good investment, you have to take price into account. Now, even though that is not the only thing you should take into account, and obviously Warren Buffett would argue time and time and time again that if you are only taking price into account, you are not investing. And I don't at all think that that is what Marx is talking about here. But he is saying that if you fail to take price into account, then you're missing out on opportunities that you could otherwise take, or you are taking on opportunities that should not have been considered in the first place. Marx really just makes the push for the idea that buying something for less than its value is what it's all about and is the most dependable way to make money over the long term. And I could not agree more. If you're going to invest in something, obviously you want to invest in something and buy it at less than what it is actually worth, and then let it increase to the value at which it is worth in order to make your profits on that investment. And so I think that is a great thought by Marx. He also talks about the most important thing being understanding risk. And we know that risk cannot be escaped because the future is unpredictable. Therefore, there is always risk, and investing has to do with the future. What is going to happen in the future? And Marx makes a statement within this book that is a bit controversial as far as the risk-return relationship, but I like his thought process. I like what he is saying here. He says that riskier investments absolutely cannot be counted on to deliver higher returns. Why not? It's simple. If riskier investments reliably produced higher returns, they wouldn't be riskier. Well, obviously, that is the case. And not only that, but the idea that riskier assets do produce higher returns is based simply on the fact that we're taking the entire universe of risky assets. And then obviously the ones that are going to succeed, the smaller group that are going to succeed over time, can succeed far more than the larger group can go down. So for instance, you can only lose 100% of your value, right? You can only lose 100% of your money in any given investment. But you can invest in something extremely risky and quadruple your money. And so you can see how the upside potential can make it look like the the riskiness of something is what makes it more valuable. But it is simply the fact that things can go up a lot more than they can go down. But obviously, in either way, obviously risk is the standard deviation. Risk is the variation of returns, either up or down. But Marx is just saying here that you can't just say, let's invest in riskier things. That's not the best idea. He also goes on to say that one of the most important things that he puts in his book is recognizing and controlling risk, because obviously risk means nothing to us if we don't see it. As investors, we need to be able to see risks and understand what certain risks are, and then be able to either hedge against those risks or take certain risks based on certain market sentiments or certain situations or valuations that are occurring. And so he's just saying you need to be able to see them and be able to control them as much as you can, because if you don't do that, then your returns will definitely be dragged down upon. He also says that the most important thing is being attentive to cycles. And like I said earlier, he has even written the book, Mastering the Market Cycle, which is a very good piece of writing on the market cycle within assets and within stocks in particular, and how you can use the cycles for your own benefit, and how they could hurt you if you fail to use them for your own benefit. And he says the number one rule is that most things will prove to be cyclical in some way. So understanding what the cycles of certain assets are is extremely important. Then he says that rule number 2, some of the greatest opportunities for gain and loss come when other people forget rule number 1. So when people forget that most things are cyclical, then you can really take advantage of the other side of those types of transactions and be able to make a lot of money. Because if people forget that those things are true, then you can end up profiting. Obviously, when a large number of people think one thing, there's always another side to that trade that can be profited upon. And the reason, he argues, for the cyclicality of markets is because it's run by humans. Things that are mechanical can go in a straight line, but anything that takes into account human behavior and human emotion is going to be cyclical, because our emotions don't just go in a straight line, and our feelings about things don't just go in a straight line. We are very ebb and flow as far as our decision making, as far as our emotions, as far as our ability to see things as they may really be, or as we may perceive them to be. Sometimes we may perceive things to be really good, or perceive things to be really bad, or whatever it may be. That's why we see in the stock market that there is a general trend line, but we end up going up and down around that trend line over time, because we are humans and our behavior tells us to do so. But understanding that cyclicality of human emotion and of human behavior can allow you to make better investment decisions. And that's what Marx is getting at in the most important thing. And he also talks about the most important thing is being aware of the pendulum. And when he says being aware of the pendulum, he's talking about investment markets following a pendulum-like swing between euphoria and depression. So like I was just talking about, we get too high, we get too low. Between celebrating positive developments and obsessing over negative things. And so I'm sure you guys have seen that in your own life. Even if it hasn't been in markets, you can see just in society. We get really high on things, really low on things. And then obviously in markets, things being overpriced and then things being underpriced. And those are really good markers as to where things are going to go next. And he talks about really two main risks, and those risks being those of losing money and the risk of missing an opportunity. And obviously you must take those into account if there is this pendulum swing of emotion back and forth, and pendulum swing of pricings back and forth. So you must understand these things. But you must also understand that pendulums cannot swing towards either extreme at all times, and it cannot reside at an extreme forever. So because we see things swinging one way doesn't mean it's going to stay that way. Things are going to swing back the other way, and back and forth they go. So it's good to understand that although it's good to notice the pendulum swing and be aware of the pendulum swing, if you get too caught up in one swing or the other, you may end up in a place where you don't want to be. And Marx also talks about several other most important things, and I just want to hit a few of them real quick. He talks about the most important things being combating negative influences, finding bargains, and being contrarian, which obviously contrarianism is something that he has talked about in some of the other most important things. But taking the other side of things can be extremely profitable, and it can be a way that you go about finding bargains. He talks about the most important things is patient opportunism. So being patient and waiting for your opportunities is extremely important, and being successful as far as your investing life goes. And I could not agree more. Obviously, many people sold off at the beginning of 2020 in response to the coronavirus pandemic. But if you had that patient opportunism, if you understood markets, if you understood risks, if you understood the cyclicality of things and how the pendulum swings, then you could have purchased, like I chose to do, stocks at that time and made really handsome gains since that time. And so that is a way that patient opportunism comes into play. Then he talks about the most important thing being knowing what you don't know. So just being aware of where you are not as competent. And Warren Buffett talks about this a lot, talking about things being out of his sphere of competency, and why he doesn't invest in certain things because he just doesn't understand them well. And that's the same idea that Marx is trying to get across here. He also talks about the most important things is having a sense of where we stand. So when others are recklessly confident or buying aggressively, we should be highly cautious. And obviously when others are frightened or in panic, we should become aggressive. This is also based on a Warren Buffett quote that, where Buffett says, be greedy when others are fearful and be fearful when others are greedy. And that is the same idea here. And then he said, one of the most important things is appreciating the role of luck. You're going to try to put an intrinsic value on something and understand the markets and understand all these things. But there is uncertainty, and there are things that can swing in certain ways, and sometimes you can get lucky. He says you just need to make good decisions, and good decisions are ones that are logical, intelligent, and informed, that would have been made under circumstances as they appeared at the time before the outcome was known. And several things go together for those who view the world as an uncertain place, and that are things like a healthy respect for risk, and awareness that we don't know what the future holds, and understanding that the best we can do is view the future as a probability distribution and invest accordingly, and insistence on defensive investing, and an emphasis on avoiding pitfalls. And obviously all of those things are extremely important when we do know that there is a role for luck in our investing. Then he also talks about the most important thing being to invest defensively, and obviously that is an important thing to do regardless of what you are trying to do in your investing life. There needs to be a defensive nature to your investing. You need to have your guard up against certain things at all times. He also talks about the most important thing being to avoid certain pitfalls. He talks about the most important thing being adding certain value. And then the most important thing is putting it all together, all of the other most important things together in order to create a perfect investment decision-making process. And obviously there is no perfect investment decision-making process, but Marx lays out all these things that if you can take them all into account, if you can try to incorporate them all and not be too analytical about it all, that you can make good investment decisions. I really enjoyed this book. The book is really easy to read, and each chapter is another most important thing for you to focus on. And the chapters are really short, but it is a very good book. I think you should all pick it up, especially in this time when there are risks that maybe we don't see, and we do want to be well-informed investors and understand the psychology of investing. Well, Marx really puts it all together in this book. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave any feedback in the comments down below if you haven't done so already, and I'll be sure to get back to you there. If you're listening on Apple or Spotify podcast, then be sure to subscribe and leave me a review on either one of those platforms. And then follow me on social media at MNO with Dylan. And that's really good supplemental materials to the things I'm putting out in these long form episodes every single day. And then if you want somebody to help you to create a plan that is specific for your financial life and to help you walk through that plan, I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that will work best for you, and we can begin pushing towards your long-term financial goals together. So tune in Monday as I talk a little bit about the Federal Reserve, the Fed, and their impact on financial markets. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.